In 2023, five banks controlled roughly 90% of Canada's banking assets. Three telecom companies held nearly 90% of wireless subscriptions. Two grocery chains accounted for more than half of all food retail. One airline dominated domestic air travel. These are not approximations, they are structural facts. And yet Canada does not describe itself as a monopolistic economy. The prevailing explanation is geographic necessity. Canada is vast. The population is thin. Infrastructure costs are punishing. Concentration is not a flaw. It is adaptation to reality. That explanation feels reasonable. It even feels obvious. But here is what does not reconcile. Canada consistently ranks among the highest in the OECD for household debt relative to income. It ranks among the most expensive for telecom pricing. It operates one of the most concentrated banking systems in the developed world, and over the past decade it has recorded some of the slowest productivity growth per worker among peer economies. High prices, high debt, low competition, low productivity. If concentration were purely efficient scale, Canadians would be benefiting from it. Instead, households are financing it. The damage is not forming, it is embedded. Canada's post-war economic model was built on a quiet bargain. Banks would be tightly regulated but profitable. Telecom companies would build infrastructure across impossible geography. Grocery chains would secure supply logistics. Pension funds would invest domestically. In exchange, the state would tolerate concentration. Stability was the priority. For decades, this worked. High wages, moderate housing costs, some rising productivity. The Big Five banks weathered the 2008 crisis better than most foreign peers. Telecom infrastructure expanded into unprofitable rural regions. Pension funds became globally respected. But the very mechanisms that created stability also insulated incumbents from competitive pressure. The system stopped rewarding performance. It began rewarding position. The first layer was regulatory entrenchment. Banking licenses were difficult to obtain. Telecom spectrum auctions favored incumbents with capital. Foreign ownership rules limited outside competition. The stated goal was prudence. The practical effect was protection. Second, capital allocation followed safety, not innovation. Canadian banks increasingly concentrated lending in residential mortgages, now over 60% of major bank domestic loan books. Mortgages were government-backed, collateralized, politically untouchable. Money flowed into housing because housing was protected. Third, firms facing limited competitive threat optimized for margin extraction. Telecom ARPU remained structurally higher than peer nations. Grocery margins widened during supply shocks. Airline pricing showed limited elasticity. These were not conspiracies, they were rational responses to limited competition. When exit is difficult, price sensitivity declines. Fourth, households adapted, facing high costs in essentials, shelter, food, connectivity. Canadians leveraged their balance sheets to maintain living standards. Household debt to disposable income rose above 180%, one of the highest in the G7. Consumers borrowed to afford concentrated markets. Fifth, government policy reinforced incumbents indirectly. Housing supply constraints drove prices upward, increasing mortgage books and bank profitability. Immigration expanded population faster than housing stock. Infrastructure investment lagged demographic growth. Each layer fed the next. Protected firms extracted higher margins. Higher margins attracted capital. Capital reinforced scale. Scale justified regulatory caution, limited entry. The system became self-reinforcing. Finally, productivity slowed. Canada's GDP per hour worked has trailed the United States by a widening margin for years. Business investment per worker stagnated. Why compete aggressively when margins are secure? Competition became a theoretical principle rather than a lived force. A young couple in Hamilton earns $140,000 combined. Both have degrees, both work full-time. They rent for $2,400 monthly. Cell and internet cost $220. Groceries run $800. They carry $60,000 in student debt. The median detached home costs $850,000. A 20% down payment requires $170,000 in cash. They do not have it. Their parents do not have it. They are not irresponsible. They are statistically above median income. They simply exist inside a system where essential costs consume income faster than savings can accumulate. This is not mismanagement. It is design drift. When grocery consolidation triggers outrage, the response is discussion of windfall taxes, not structural competition reform. When telecom pricing becomes controversial, temporary relief plans are announced, not open market restructuring. When banks report record profits during housing inflation, the solution is marginal stress test adjustments. The outcomes repeat because the incentives repeat. Banks prioritize secured lending because capital rules reward it. Telecom firms invest where returns are highest because spectrum costs demand it. Grocery chains optimize supply chains because shareholders require it. The Competition Bureau, chronically under-resourced relative to national incumbents, faces asymmetry in legal and financial capacity. Challenging a billion-dollar merger requires years of litigation. The Bureau's budget is a fraction of what a single incumbent can deploy in legal defense. This is institutional capture without overt corruption. In 2013, the government attempted to inject telecom competition by setting aside spectrum for new entrants and lowering foreign ownership restrictions. By 2024, most had been acquired by incumbents or exited. Prices declined modestly, then stabilized. The structural concentration remained intact. Why? Because spectrum is expensive, infrastructure is capital intensive. Incumbents have economies of scale new entrants cannot match quickly, and regulatory frameworks prioritize network stability, goals that favor incumbents. The system is not designed to fail, it is designed to persist. Japan in the 1990s offers a warning, not of collapse, but of drift. Large incumbent firms protected by regulatory caution. Capital recycling into asset markets rather than productivity investment. Demographic pressures compounding stagnation. Japan avoided crisis. It did not avoid stagnation. Canada's concentration trajectory echoes this pattern. Stable banks, high asset values, declining dynamism. The difference is that Japan's stagnation followed a speculative collapse. Canada's is occurring without one. The asset values are real, the balance sheets are sound, the institutions are solvent. But the option space is narrowing. A developer in Vancouver applies for rezoning to build 120 apartment units on a site zoned for single-family homes. Rental vacancy is below 1%. Homeowners oppose it. Property values might be affected, traffic might increase, they attend meetings, they submit objections, they hire consultants. The developer has capital and market demand, but the homeowners have city council. And council depends on homeowners for re-election. The rezoning is delayed, modified, delayed again, eventually approved, but reduced to 60 units with parking requirements that make the financials marginal. The developer builds anyway, but the per-unit cost is higher. Those costs are passed to renters. No one broke the law. The system operated exactly as designed, but 60 units were built instead of 120. Why not simply break it up? Because every pillar supports something politically essential. Banks underpin pensions, mortgages, and provincial bond markets. Telecom firms maintain infrastructure across remote regions. Grocery chains anchor supply logistics. Airlines connect provincial economies. Disrupt incumbents too aggressively, and volatility increases. Increased volatility and housing values fluctuate. If housing fluctuates, household balance sheets weaken. Canadians hold more than $2 trillion in residential real estate equity. That equity finances retirements. It collateralizes business loans. It underpins consumer confidence. If households weaken, banks retrench. If banks retrench, credit tightens. If credit tightens, growth slows. If growth slows, unemployment rises. This is the feedback loop trap. High concentration sustains high asset values. High asset values sustain political stability. Political stability sustains concentration. Voters depend on the same institutions they resent. There is no clean intervention point. Every lever touches housing. Every housing adjustment touches banks. Every bank adjustment touches pensions and provincial debt. The exit becomes more expensive than continuation. In 2022, Canada's productivity growth ranked last among 30 OECD countries. GDP per hour worked grew 0.1%. The United States grew 1.5%. The gap has been widening for more than a decade. What does 0.1% productivity growth mean mechanically? It means the average Canadian worker produces almost the same output per hour as the year before. It means wages, in real terms, cannot rise faster than productivity without triggering inflation. It means living standards cannot improve without households borrowing more or working longer hours. Productivity growth comes from more capital per worker, better technology, or better organization of labor. Canada has access to capital and technology, but capital flows into real estate, not business investment. Technology adoption lags because competitive pressure is weak. The result is drift. Firms earn steady returns, dividends are paid, asset values appreciate. But the engine that turns income into wealth, productivity growth, stalls. And when productivity stalls, the only way to maintain consumption is leverage. A recent graduate in Toronto with a computer science degree receives 2 offers. One from a Canadian bank, $75,000 with pension contributions. One from a U.S. tech company's Canadian office, $95,000 with stock options. She takes the U.S. offer. 2 years later, she transfers to Seattle. Her salary increases to $140,000. Canada trained her. Canada subsidized her education, but Canada could not offer the wage growth or career trajectory available elsewhere. When the most mobile talent exits, the system loses internal pressure for change. The people most capable of building competitive firms or driving productivity gains leave. Those who remain adapt within the existing structure. The pattern is now legible. Rising housing prices strengthen bank balance sheets. Strong banks finance further mortgages. Elevated margins finance dividends and reinforce investor loyalty. Investors include pension funds, which depend on stable returns. Policymakers avoid disruption to preserve asset values. Because asset values underpin household wealth and political stability. Each actor behaves rationally, but the system drifts toward lower dynamism. This is not conspiracy, it is emergence. No single actor designed it, but every actor reinforces it. And the longer it persists, the more expensive disruption becomes. Reform proposals encounter structural resistance. Breaking up banks risks credit contraction. Liberalizing telecom risks infrastructure underinvestment. Aggressive antitrust enforcement risks volatility. When the Competition Bureau proposes blocking a merger, firms can litigate for years. They can hire economists to produce efficiency studies. They can lobby parliamentarians. They can appeal through multiple judicial layers. The Bureau's 2023 budget was approximately $50 million. The legal budgets of the firms it regulates are multiples of that. This is not corruption. It is asymmetry. The immediate institutional response to public frustration is procedural. Reviews, consultations, marginal adjustments. Stability is preserved. Structural change is deferred. Policymakers face a dilemma. Disrupting incumbents risks destabilizing the systems voters depend on. Maintaining incumbents risks entrenching the conditions voters resent. Political systems are optimized for managing immediate, visible costs, not gradual, diffuse costs. If the current structure persists, the trajectory is not collapse. It is compression, higher household leverage relative to income, higher margins in essential sectors, lower entrepreneurial entry, slower productivity growth, gradual erosion of wage competitiveness. Those with equity, property owners, institutional investors, incumbents, adapt and consolidate further. Asset appreciation becomes the primary mechanism of wealth accumulation, not income growth. Those without assets adapt by delaying ownership, delaying family formation, or leaving. Capital remains domestically concentrated while talent becomes mobile. Canada remains stable. But stability is not prosperity. It is endurance. The choice facing Canada is not between monopoly and competition in the abstract. It is between institutional comfort and generational dynamism. And that choice is not being made through speeches or reforms. It is being made quietly. Every time stability is prioritized over entry, every time consolidation is approved for resilience, every time rising asset values are mistaken for rising prosperity. The system does not require anyone to be evil. It requires everyone to be rational. Households borrow because they must. Banks lend because it is safe. Firms consolidate because competition is limited. Regulators approve because disruption is risky. Politicians defer because voters are asset holders. No one is lying. The rules are being followed, but the rules were written for a different economy. One where competition was discipline, not theory. Where entry was possible, not procedural. Where productivity growth was expected, not optional. That economy is memory. The one Canadians live in now operates on different logic. Incumbency is value, position is power. Stability is the goal, and stability pursued long enough becomes indistinguishable from stagnation. The system is not broken. It is working exactly as designed. The question is whether Canadians can still afford it.